Hi, everyone. I'm James Lange. I am a parent of a child with a disability. I'm also a CPA and a state attorney, and I've been working in the IRA, Roth IRA, Roth conversion area since Roth IRAs came out in 1998. And I've written 10 financial books for IRA and retirement plan owners. I've been in the Wall Street Journal 36 times, and I'm passionate about helping parents with a child with a disability, and that's why I wrote the book, Retire Secure for Parents of a Child with a Disability. And what I'd like to do over the next couple minutes is give you a couple, what I would say, key points, and I'll talk about generalities, and then I'll get into the specifics a little bit. But before I get into the specifics, I'll just say that course, as a CPA and an estate attorney and a financial planner, I'm a big believer in getting your planning right. And that I would say this would be true for anybody. But if you have a child with a disability, and particularly assuming that that child is very likely to survive you, one of your biggest worries in life might be, or certainly was for my wife and me, is how can we provide for our child after we're gone? And getting that right is really mission critical. If you kind of bought your estate planning and you're planning for a child who is able to go out and get a job, I'm not saying it's a good thing. Of course, it's a terrible thing. Let's say your child inherits 200,000 instead of a million if you got everything right. Yes, that's bad, but I wouldn't call it a tragedy. If that happens and the beneficiary is a child with a disability, the difference between inheriting $200,000 and $1 million, that could be a tragedy. So you really want to get these right. Now, what I would like to do is kind of go through the logical order, subject to exception, but the main logical order, and then I'll talk about the area that isn't talked about very often. The first thing, mission critical, is to get your child qualified for SSI and SSDI. So that is a government benefit. SSI is actually a poverty program, so you typically can't get that child qualified until they're 18 because the Social Security Administration will take your income and your assets into consideration until the child is 18. But when the child does become 18, it is critical to get that child qualified for typically SSI, typically you switch to SSDI later. You get a cash benefit depending on the number of things. It might be $900, $1,000 a month. But that might not be nearly as important as some of the health benefits, the insurance, Medicare, Medicaid, tuition, special equipment, college tuition, vocational school, and some major estate planning benefits. So that's really mission critical. The first thing is getting your child qualified for SSI or SSDI. The second thing is to develop an optimal estate plan for your child after you and or your spouse die. Typically, the estate plan will consist of a special needs trust. And the point of that trust, there's two really important things about it. One, it is designed so you're not leaving money directly to the child, because if you did that, then the child might lose a lot of government benefits. So it's called a special needs trust, and basically it is to provide the child with certain types of support, but still to preserve the benefits. The other thing that's critical about this trust that a lot of estate attorneys don't get right is that this trust must meet 5 conditions in order to qualify as what's called an EDB, eligible designated beneficiary, that will allow the trustee to stretch or defer the distributions from the inherited IRA or the inherited Roth IRA over the child's lifetime, instead of if you leave money to a child or somebody that doesn't have SSI or SSDI, they will have to take all that money out within 10 years of your death. And the difference between having tax deferred as in an inherited IRA, or better yet, an an inherited Roth IRA, which means you get tax-free distributions over the life of the child, can often mean tens, hundreds of thousands, or in my daughter's case, over $1 million better off than if we hadn't got that. And the last area that I want to talk about, right? And the last area, which is the area that is probably the least publicized that I have seen, is to do a series of Roth IRA conversions and to have an optimal long-term Roth IRA conversion plan. And one of the reasons for this and why it is so much more important to get this right for a child with a disability than with a child who doesn't qualify for SSI or SSDI and doesn't have a disability, at least it is recognized by the Social Security Administration, is that if we can stretch or defer the distributions over the child's life instead of 10 years, the math on that, when you work out the numbers, and by the way, all this is math. This isn't really opinion. This isn't, oh, Jim Lange. This isn't like I like Whitney Houston and you like Barbara Streisand. This is math. You could argue about the assumptions, etc., but the math indicates that if you get this, for most everybody, if you get the series of Roth IRA conversions right, and depending on where you are in your life and your income and your future income, et cetera, and then there's an advanced technique to even do a Roth conversion after you're gone, it can just make the difference of, hundreds of thousands of dollars. Even somebody with a $500,000 IRA, their kid can be better off in today's dollars, forgetting about government benefits, by $289,000 if you get a relatively simple Roth IRA conversion strategy right. So it's really mission critical to do all three of these, which is qualify your child for SSI or SSDI, get your estate planning right, preferably, to me, it's a specialty area, and you have to be, as a state attorney, must be licensed in the state where you live in order to practice. But to me, what's maybe even more important, although you have to use somebody that's obviously a licensed attorney, is an attorney who actually has experience. And this isn't the first or second estate plan they've done that has a child with a disability. It's an area that they frequently do. And then whether you do it on your own, and one of the points of me writing the book is to provide a lot of information, literally a couple hundred pages, about some of the financial strategies that mainly revolve around saving taxes for so many years after you're gone, with Roth IRA conversions, ABLE, and then a whole bunch of other strategies. You really want to get this right. And again, it's mission critical. As a math and a numbers guy, I sometimes get caught up. If you read the book, there isn't a lot of emotional stuff, some stories, but a lot of it is strategies. But it equates to major differences in the quality of life for both you and for your child. So that would be my let's say, final recommendation. I believe that the magazine is going to make the book available for free. If not, you can get it on Amazon. It literally came out today. You can get a digital version for $1.99. If you get it on Amazon and you send us a receipt on that, we have a whole slew of bonuses, of workshops and interviews with Burton Malkiel and John Kramer. I'm sorry, John Bogle, and so a lot of good information. But anyway, the overriding one message is this is mission critical. It should not be put off. You want to get your planning right as early as possible. Get it done. It will be, as it was for me and my wife after we were done with it, a huge anxiety reduction action point. And the thing I didn't quite understand, a huge anxiety reduction for our daughter, who was very concerned, gee, what's going to happen to her financially after we are gone? I hope this has been helpful. Thank you. I'm James Lange.